Hello, today's video is going to be the features and setup video for the Day Trading GPS Nasdaq NDX Index Daily Key Levels V3.0 indicator. Okay, so some of you may already be familiar with the SPX V3.0 indicator or our Stocks V3.0 indicator. If you are, a lot of this information may seem redundant to you because if you've already gone through the other videos, a lot of the same features are going to be the same in the Nasdaq NDX Daily Key Levels V3.0 indicator. For those of you who have just purchased this indicator and do not own any of the other V3.0 versions of the other Daily Key Levels indicator, we are going to go through the full user control panel, and we will go through an overview of all the different features of this indicator. Okay, so today is Friday, April 3rd, and it is the Friday before Easter, so the markets are closed today. So the charts that we'll be looking at will mainly be replay charts since the market is closed today. Okay, so we're going to start off by going through the user control panel first. So we'll just go over here and highlight this up here, and then we go click on the settings. You'll see here at the top there is a box for indicator information, disclaimer and risk warning, and also an important notice. This is something you definitely need to read. A lot of this information here is also in the PDF user guided manual, which you should have received via a Google Drive link. You can certainly download that, print it out, or just keep it on your computer as a PDF. That is up to you. So this box here goes off with some general information regarding the indicator in general, what symbols it works on. It works on 3 symbols related to the Nasdaq NDX. It works on the Nasdaq NDX main, that is the main Nasdaq official NDX index. It also works on the AAP NDQ CFD, which is a forex CFD symbol. And the third symbol it works on is the XND, that is the Nasdaq 100 micro index. So that trades at 1/100th the value of the regular Nasdaq NDX index. You do need to subscribe to real-time quotes on TradingView for CFDs as well as the Nasdaq global indices for the indicator to work properly. So make sure that you do have the Nasdaq data feed through TradingView in order to get the real-time quotes for the Nasdaq NDX index. This indicator will not work properly on delay quotes. You will need to subscribe to real-time quotes. The indicator is for day trading and not swing trading, and it's designed to work on specific chart time frames of 30 minutes or less. So you need to set your chart time frame to a time frame that is at least 1 minute or at most 30 minutes. If you try to use it over a time frame of 30 minutes, you will see a disclaimer message that comes up on the chart. The recommended chart time frames used for intraday trading are somewhere between 1 minute and 5 minutes for our daily key levels trading strategy. The 2-minute chart time frame is the chart time frame which is most commonly used in our YouTube videos for both the NDX index and the SPX index as well. However, the specific chart time frame used is up to you, as you may find a different time frame that you prefer through practice in the particular trading strategy you prefer to use with this indicator. So keep in mind that although we do provide our daily key levels trading strategy in the user guided manual and as also explained in many of our YouTube videos on trading both the SPX index and the NDX index, the real value in this indicator is not the daily key levels trading strategy that we give you. It's mainly in the strategic intelligence framework that the indicator gives you daily through the daily key levels as well as the contextual levels and the automated market scenario analysis. So if you already use a different type of trading strategy, such as credit spreads, iron condors, butterflies, or any type of combination trading strategy that involves a combination of options rather than our daily key level strategy, which is simply buying puts on bearish entry signals and buying calls on bullish entry signals. You can certainly use this indicator for your own trading strategies that you prefer, and you'll find that these levels are very good for those trading strategies as well, and will be your daily elevated intelligence for the daily framework that the indicators levels give. Okay, so going through the rest of this here, it generates the daily bull bear key price level, the BBKPL, and daily main R and daily main S levels for the main Nasdaq index at different EST New York times, depending on which symbol you have your chart on, either the Nasdaq NDX symbol or the AAP NDQ CFD symbol. So if you want to get the levels 30 minutes before the Nasdaq NDX index opens up at 9:30 a.m. Eastern New York time, you can open up a second chart and put it on the 8-cap NDQ 100 forex CFD symbol. So we'll just take a quick look at that now. Okay, so as you can see here, we're on the NDQ 100 chart. You can find the NDQ 100 by just typing in the symbol search NDQ 100. Then you look for the NDQ 100 symbol under 8-cap. Okay, so we're on the replay here. We're starting off uh, earlier in the session. The Nasdaq NDQ 100 trades in the overnight and the pre-market. So the advantage of being able to utilize the second chart on the NDQ 100 is that if you want, you can get the levels for the NDX index 30 minutes before it opens at 9:30 a.m. Eastern. You can get them at 9 a.m. While you're on the NDQ 100 chart via this second table up here. This table down here is the NDQ 100 levels. These levels are the NDQ 100 levels. However, this table here is the table for the NDX main official index. So then at 9 a.m. you'll see these levels change. We'll go through just forwarding this right now. Okay, let's go back and we will do this in slow motion. We'll go back and select this bar here. All right, now we'll just move it one bar at a time. All right, so there you see at 9 a.m. you will get the new levels for NDQ 100. Then you will get the new levels here for the Nasdaq NDX regular index. Having these levels 30 minutes early can be an advantage depending on what type of strategy that you're using, because it gives you a 30-minute window before the open to do some planning for the session if you wish to take advantage of that time. Now we'll take a look at the other symbol that this works on, the XND. Okay, so as you can see here, we have not forwarded it to the next, the open yet. The XND is like the NDX. It does not open until 9:30 a.m. So you'll see the final candle here from the previous day on 4/1, which is the final candle. And we'll just go ahead and move this to a 2-minute chart now. So you can see on the first tick here, we have the new levels that come on the screen at 9:30 a.m. Eastern New York time. You also have your market scenario analysis here. Next, we'll just take a look at the same thing on the NDX chart. Okay, so as you can see here, we have the April 1st, 2026 session still here, 3:40 p.m. We'll just go ahead and forward this. All right, so we have the first candle here. You can see at the 9:30 a.m. open, the levels have all changed. Now we have our new market scenario for the April 2nd session. Now we'll just go back to our regular chart. Okay, so now we have a replay back of the April 2nd session here, and we've stopped it here at the 11:18 candle. We'll go back to the user control panel and go through the rest of this. Okay, so first of all, you have the 6 levels here. The 6 levels are your default levels. What this means is R1 through R6 and S1 through S6. Now these two tables here are optional to turn on. They are on the small size at the moment. That's the default size for this particular indicator. However, you can go down here to the table section, and you can turn on. Here's the one for the NDX price level table. And for example, if we just turn this on normal, you'll see that it increases in size. And then this one here is the PMH, PML, YDH, YDL, YDC Levels table. Do the same thing here. You can change the size. Everyone's different. Some people like to have these tables on their chart. Some people don't. Some people are fine with them if they're a smaller size. You can also change the table position if you want. The top right is the default position for this. The top center is the default position for this. You can change the position if you'd like. The NDQ table, the bottom left is the default for that, and its text size is normal. Okay, so let's just go back up. Now, as far as these levels, if you don't want to have all 6 levels as a default, you simply uncheck which ones that you prefer not to have on. So, for example, if you just wanted R1 through R3 and S1 through S3, then now you'll just have that on your chart. And then also, if you do that, the table changes dynamically to just have those levels here. And as you can see here, now we just have R3 through S3, and we still have the contextual levels here. Next is the display settings. These are by group. So these are global settings by group. So the mainline extension options, mainline label offset, and mainline label text size. So the main, what is defined as the main lines here is the NDX bull bear KPL, the R levels above, and the S levels below. The both here means that the lines are extended in both directions. So for example, if you just wanted right only for these, then you could change them to right only. And as you can see here, now we're just going on right only. You can do the same with the midpoint levels. If we change all of them to right only, Go ahead and change the quarter line levels, the QL levels. And now as you can see, everything is right only. So if you prefer this look, you can change it to right only. We'll come back to this later when we look at historical sessions. As you're doing historical sessions analysis, using the historical session analysis tools of this indicator, you will want to put all these on right only for that. The default though is both. Just up to traders' preference as to what you prefer for your look and feel of your chart. Now the line label offset controls the horizontal offset of the line label text. So what 50 means is this is a positive 50. You can also put a negative number in by simply putting a dash there. For right now, we'll just leave it the way it is. What this means is that this is 50 bars. The middle of the text is 50 bars to the right. If we were to change this, say, to 30, then it would move it to where it's only 30 bars to the right. So as an example, we've changed it to 30. Now it'll move more to the left. And now the middle of all the group of the mainline labels is now 30 bars away at the middle of the text. If you made this 0, then the middle would be right at the current candle. So the middle of the text would be the current candle. If you put in a negative number, so something that is below 0, for example, if you put in minus 30, then it will move it 30 bars to the left. So we'll just go back to the default 50. So that's again just up to trader's preference. That's the default settings. You can put them on whatever you want. All of these are individually controlled. So we have, at least my preference is to have them all be the same offset because I like to see them all in a row. Then I like to see all of the YDH, YDC, YDL, PMH, and PML all in the same offset as well, all in a row. If you prefer different, then you can, these are controlled by a group, YDC, YDH, YDL, as we'll see later in a different section. The PMH and PML are controlled by a group. The midpoint lines are controlled by a group. The QL lines are controlled by a group, and the main lines are controlled by a group. You can also change the line label text size. So right now the default is the main lines are on large. The midpoint lines are on normal, and the quarter lines are also set to normal, known as the QL lines. So for example, if you prefer these to be normal as well, you just simply go here, change them to normal. And you can do the same with all these. You could make the midpoints large too if you want, or you can make them smaller. It goes from tiny up to huge. Same with the quarter lines. You could leave them as normal, you could make them smaller, or you could make them larger. Next, we have the Bull Bear KPL line color, which is default yellow. Line width is 1. You could increase it if you want. It goes all the way up to 5. So as a 5, you can see it becomes very thick, and you can just step it down. For example, if you wanted to leave it on 2. And then you can control the color and line width here for the R levels and the S levels. Below that, you can control the line style. So for example, the Bull Bear Key Price level, you have the line style here if you wanted to change it to dashed instead, or dotted. So you can do the same here. You can change these from solid to either dashed or dotted. Next, we have enable midpoint lines, enable midpoint labels. By default, the indicator by default has the midpoint above the bull bear KPL and the midpoint below the bull bear KPL turned on. It also has the QL above the BBKPL and the QL below the BBKPL turned on by default. The reason for that is in the beginning of a session, most of the time, the levels in play, the level in play at the beginning of the session is going to be the bull bear key price level. And then we'll get into what these midpoint levels and QL levels mean as far as trading and the relevance. Just know that you can turn on the other midpoint levels if you want. Sometimes it's a good idea to just turn on mid R1, R2 and mid R2, R3, as well as mid S1, S2 and mid S2, S3. Now, if you find certain settings, you can also save as default specific settings once you get all of your settings set up. If you don't like our default settings, you simply get all of your settings set up the way you like them, and then you can save them as the new default. You can always reset them by just going back to reset settings, and then it's back to what our default is set at. Now, right here is a good point to go over another subject, which is the look of the display on startup at the start of a session. So at the start of a session, we'll just go back and we'll change this select bar to say just after the start of the session here. Some of you that are already familiar with TradingView, you may already have your chart set to auto fits data to screen. So if you're one of those people that does, this is what you're going to see when you have all 6 levels and you have all the midpoint levels turned on, as we turned on a couple of other ones. So as you can see, this is not a good look. Everything is too compressed here. So what you do, if you normally have your chart set to auto fits data to screen, you want to go ahead and go over to the left right price axis. So you go over to the right price axis and you left click your mouse and hold it, and then you simply move and expand the chart. Normally, now you can see here on this particular day, you have YDH all the way up to R4, and you have YDC here next to R3. So it really depends on which levels are most important to you at the start, because you can trade these levels as well, and you can also take trades off of any of the R levels or any of the main S levels, as well as the bull bear KPL. So depending on which levels that you prefer to trade, you just want to make sure that those levels at the beginning are showing on your chart, because these will change, especially these contextual levels on any given day. Sometimes they're not as spaced out as they are in this particular session. But normally what you'd like to see is R2 down to S2 or R3 down to S3. So for example, if we were going R2 down to S2, then we would simply move our chart from here, and then we'd have a look something like this. Now you can also change this if you don't like this here. Like I said, you can either turn it off, or you can just simply go down and go to the here for the Nasdaq NDX price level table, and simply move it from top center to say bottom left as an example. That is, if you still want it on your chart to view, this will simply just move it out of the way. You can also simply turn it off, and you can turn off this table. They're both independently controlled. So if, for example, you don't really prefer to have them on your chart, you can simply turn off this table here, and then you can turn off the Nasdaq NDX price table here. And then this would become the look here. R2 down to S2, normally in the first part of the session, say for the first 30 minutes, typically on most days, most of your action is going to be confined to the R2 to S2 level or the R3 to S3 level. So that is the reason for zooming in on this. However, if it's also important for you to see the YDC, YDH, and YDL level, then you will want to expand your chart out a little bit more to also include those. Another thing I just want to point out real quick, some people will have these labels turned on. So right now, as you can see, I just have indicator and financial value labels, but some people have indicators and financial name labels turned on. If you do that, then this is what you're going to see. You're going to see the full name of the indicator along with the level here. Now, if you prefer that look, that's fine. Just letting you know that if you see that, then that's why that's happening. So if you don't want that, then you just simply uncheck indicators and financial value labels. As you can see, I've taken away both of them, and now we don't have the color coding over here. So as an example, if I turn on indicator and financial value labels, which is what it was before, then we have these highlighted over here. If you don't like that, you can simply turn that off. And then, like I said, if you have that on, it's going to look like that. And if you have this on, it's going to look like that. My preference is just to leave the indicator name off, but leave these highlighted. But every trader is different, so whatever your preference is. Also, another thing you want to be aware of is that some traders will have some of these other things turned on the status line. So right now, as you can see, I only have logo, title, symbol, name, and titles of indicators. Now, if you have inputs and values turned on, then you're going to see all this up here, which is completely unnecessary. So if you see that on your chart, what you need to do is just go up here and you turn off inputs and turn off values. And you can just leave title, because if you take title off, then you can't see the title of the indicator. And it could be important for you to do that, because then you could come here and possibly change a setting, go in and turn on a specific level that you want turned on, midpoint level or QL level, etc. Or as you'll see, some of the other functions that we have in here for stop loss and take profit. So generally, you do want to keep at least the title one on. For all these midpoint lines, you of course can change the color, you can change the line width, and you can change the line style. Next we have the quarter lines, which are the QL levels. By default, the QL above the BBKPL and the QL below the BBKPL are turned on. This is where you would turn on the other levels. So for example, if we want to turn on the QL line below R1, we simply do that. And now we have the QL below R1. And you can turn them above or below each level. So each one is line below followed by line above. It just goes down from the BBKPL. Below the BBKPL is here. So it basically follows the path of all the BBKPL followed by the R levels. then below BBKPL, followed by the S levels. And again, you can change the color of the line, line width, and line style if you prefer. Next, we have the historical session for the BBKPL line. Historical R and S lines and historical midpoint lines. We'll go over this section later. I'm just showing you where they're at now. Thoughts followed by the pre-market values. So this is pre-market high and pre-market low. This is turned on by default. Here is the pre-market line extension options. So again, in historical sessions, if you're doing that and you want to see pre-market high and low each day in historical sessions, you'll want to change this to right only, as you'll see later. Here's the pre-market line offset. It works the same way. 15 means 15 bars to the right in the middle of this text. Moving it to a greater number would move it over to the right. Changing it to a lesser number moves it more to the left. 0 means it's right on top of this. A negative number means it's more to the left. You can, of course, change the size of the line label text. So, for example, if we put it on normal, then it's going to change these to normal. Next, we have the line width, line color, and line style if you want to change those. This is where you would enable historical PML, PMH lines if you want to enable the historical ones. That's followed by the previous daily values, so that's YDL, YDH, and YDC. Have the same controls. We have the line label offset. We have the line label text size. Here are the default colors. You can change the colors if you wish to make them something different. You have the width, line style, color. Here's where you would enable the historical YDH, YDL, and YDC levels. Next, it's followed by the AAP NDQ price level table. Its default is bottom left. Its default text size is normal. Followed by the Nasdaq NDX price level table. This also doubles as the XND price level table. There's no reason to have a separate control for that. If you do happen to trade XND, the levels will show up automatically on this NDX price level table. Default for this is small and top center. You can of course change that as we went over before. You can also change the header background color, the colors for the R1 and S1 levels, and the colors for the R levels and the R2 through R6 and S2 through S6. You can of course do that with the other ones as well. Next, we have the stop loss and take profit levels section for the PML, PMH, YDL, YDH, and YDC levels. So with this indicator, you can take trades off of these 5 contextual levels. If you do, you use the user control panel for that, for at least the stop loss part. You can also, as we'll see later when we go through that section, you can also plot the target exit level as well through a reward risk multiplier. However, with the main key levels, the bull bear key price level, the R1 through R6 and S1 through S6, that instead is done through the other levels here on the chart, which we'll go over when we start the trading section, how to trade with this indicator, which we'll go over. We'll go over the details of all that. But just know that those are, as far as targets and stop losses, that is all done here. Stop losses are the midpoint levels and QL levels. QL levels are the tight stop losses, and the midpoint levels are the standard stop losses. As far as target exits, that is done in a couple different ways. Target exits are defined by what type of trade that you're doing with the main key levels, whether you're doing a scalp only trade or whether you're doing a regular trade. We'll go through that when we get through to the trading section, and that is all of this, just by the way, is all covered in the user guide and manual as well. Okay, so in this section here, this is turned on by default. However, you also will need to enable what particular entry stop loss you want for what particular level to be plotted, and then also what the take profit is. So this on by itself doesn't do that. You also have to turn on the specific level that you want. Here we have the line extension options. Their default is both. The line label offset, because the stop loss and take profit lines also have line labels. This is the offset control for that, for moving them more to the left or more to the right. And then we have the line label text size set to normal, which also has the same options for tiny, small, normal, large, and huge like the other ones. Next, you'll see the bullish entry stop loss and take profit levels for PML, PMH, YDL, YDH, and YDC. So that goes through each one of those, followed by bearish entry stop loss and take profit levels for all of those as well. So you have a separate bullish trade section and then a separate bearish trade section. Now we've come to the main key levels alert section. You'll see here a acceptable range percentage. This is a filter which you can enable. As you can see, it's set to 85%. We'll just highlight this tooltip here, and as you can see, it is a percentage of 1.00 standard key level. A standard base key level is the distance from the BBKPL to R1 or S1. It's also the same distance between R1 and R2 and S1 to S2. So as an example, bull bear to R1 is a base key level. R1 to R2 is the same distance, so that is also a base key level. However, as you can see, there's a lot greater distance between R2 and R3, and R3 and R4, and so on and so forth. So the 85% is 85% of the distance between a base key level. That is important for risk to reward. What it does is it keeps you from entering into overextended candles and basing a trade off of a certain level based on an overextended candle, because the candle is closing either too far above or too far below that particular level to fire that alert. So with that filter on, you would not see the alert come up if it was over 85% or whatever that you have it set to. Our recommendation is that you leave it at a max of 85%, which is the default. However, if you find for your purposes that you prefer to have a different setting that is less than 85%, then that would be the direction you would go in if you want to have a different setting. So 85% would be the max. That is the default. However, if you prefer a setting that is less than that, then that is certainly something to consider through practice. So as an example, if we're looking at a close above the bull bear KPL, the midpoint line is going to be 50%. The QL line is 25% above. The midpoint line is 50% above. The QL below R1 is going to be the 75% level from the bull bear KPL if you're looking up. Same thing in reverse on R1. If we're looking for a bearish trade on R1, the QL below R1 is 25%. So on a close below, if the close was at the QL level below, it'd be 25%, midpoint 50%, and this level 75%. So 85 would be a close below that would be a little bit further than this level here. If it went all the way and closed at the bull bear key price level, let's say it was up here, and it closed all the way down here right at the bull bear key price level, that would be 100%. If it closed at this level below it, it'd be 125%, and below here at the midpoint level would be 150%. 150% of a base level away from a close below the R1. And it works the same way in reverse. Close above the bull bear key price level. If a candle closed above and it closed right at R1, it'd be 100%. If it closes at this midpoint level above, it'd be 150%. So 85% is slightly lower than the halfway point between the R1 and the QL level. So for example, if you set this to 50%, then you're saying that you only want to be alerted when it's either closing at this midpoint level above any level on a cross and close above, or somewhere in between. Same thing on a cross and close below alert. If it was set to 50%, then you're saying that the max would be here at the midpoint level. If you leave it at 85%, then it would be somewhere down in this range. So again, either leave it at the default of 85%. There's an important reason why it's at 85%. That is the max amount to be considered for a trade off of that level. What that really means is that, for example, on a cross and close above the bull bear key price level at 85%, you're right here. On a bullish trade from the bull bear key price level, your tight stop loss is the QL below the BBKPL, and your standard stop loss, if you choose that instead, is the first midpoint below the bull bear KPL. So as you can see here, if you're at 85% here, that is basically the extent of the maximum range for having a risk reward based on these being the stop losses. The closer that this is, then the less distance between the stop losses and the close. So that's why if it closes above 85%, it is simply too far away, and 85% would be considered the max. And even at the max, that's still fairly far away. So better entries are ones that are closer in. Okay, the alert label size, you have a choice between tiny, small, and normal. We'll get to that when we go over the alert section, when we actually go through and look at the alerts. Show last alert only, that is a filter that can be turned on. What this does is when enabled, it only will show the most recent alert label of a specific key level plus the direction. So what that really means is it's kind of a decluttering filter that if you only want to see the last alert shown for each level, now this is going to show it for each enabled level that you have the alerts enabled for. So if you have alerts enabled for 5 different levels as an example, you would see the last alert for each one of those 5 different levels only. You would not see all of the previous alerts for all 5 of those levels. So it's really just meant as a chart decluttering filter if you prefer to only see the last alert only for each of the particular enabled alerts. So when we get to that section, we'll go through and just show you an example so you can get the idea with that. 9:30 a.m. opening candle close BBKPL level alert. This is an alert that is for a single standalone candle, and that is the 9:30 a.m. opening candle. So this alert is going to show for only the 9:30 a.m. opening candle. Now, as an example, if we turn this on, and we apply the range filter is set to 85%. And as you can see here, we have no alert, and that is because this is the opening candle, It is closing above the bull bear key price level. However, it is closing greater than 85%. Now we'll change it here and we'll make it 100%. Now you can see 100% is the R1 from the bull bear key price level, and now we see the alert. However, you don't want it set to 100%, so that's why you're not seeing the alert when it's on the max of 85%. So what this alert is going to do is that it's going to fire and show you the alert if the opening candle closes above or closes below and is within the acceptable range set by the filter. If it's a close below, then you're going to see a red label that will be on top of the candle in question. If it's a bullish close above and it's within the acceptable range, then you will see a green label below the candle in question, just like we saw a few minutes ago. You can change the alert label size. You can also change the alert label above color and alert label below color. And remember, this is only for the opening candle. So whatever chart time frame you have your chart set to, that is going to be at the close of that candle when that alert will either show or it will not show because it's outside the acceptable range. Now here we have crossed and closed above alerts. So this is going to be here, master switch for enable crossed and closed above alerts. So if you want to have any of these turned on, you will need to turn on this master switch for crossed and closed above alerts. And then you simply turn on whichever alert that you want for crossed and closed above. And you can decide if you want to apply the range filter or not. If you do apply the range filter, this range filter is a global setting, so it will apply at 85% if that's what it's set to anything that you check. Okay, so you have for each of the levels here, BBKPL, R1 through R6, and S1 through S6. You also have it for the 5 contextual levels, the PMH, PML, YDH, YDL, and YDC levels. Next, you have the crossed and closed below alert. Same thing here. You have to turn on the master switch, and then you have to then decide which one of the levels or multiple levels that you want to turn on, and again, whether you want to apply the range filter or not. Next, we have the market scenario table section. Here is an important note and risk disclaimer regarding market scenario analysis, which you can read through at your leisure. One of the most important things that it's just pointing out here is that it's provided for educational reference and informational purposes only, and should not be used as the sole basis for any trading decision. Market scenario tendencies are probabilistic, not deterministic, always confirmed with price action, volume, and broader market context. News, economic releases, and overall market sentiment can override structural tendencies. So basically what we are pointing out here is that nothing is 100% in the market. What the market scenario analysis table does, as we'll see in a second, is it will give you the dominant market characteristics and tendencies, and also key characteristics of the specific market scenario that we find ourselves in today. There are only 6 different market scenarios that a symbol can open up with. This applies to not only the NDX, the SPX, but every stock and every other instrument, and that is the relationship between the pre-market high and pre-market low and yesterday's RTH daily high and yesterday's RTH daily low. Based on those levels and the relationship between them determines which one of the 6 market scenarios that you're in for this session. So we'll go back and we will turn on the table for these levels here. As you can see, we have MS3 on this table, full gap below. That's only one of the ways that you can get the market scenario. So that's not the full analysis here. The full analysis, you have to turn on the market scenario analysis table. The bottom left is the default position of the table, and also the normal text size is the text size for this table. So as you can see here, we have the symbol NDX. We have the analysis for the April 2nd session, market scenario 3, full gap below. What full gap below means is if you have just a market open that is below yesterday's daily low, then that is technically a gap. However, it's not a true gap. A true gap is where the pre-market high and the pre-market low, the entire pre-market range, is below yesterday's daily low. So that is a true gap. So here we have an explanation of what exactly this means. We also have a reprint of the levels here. Again, the only 4 levels involved in this scenario are the YDH, YDL, PMH, and PML. The YDC does not factor into the market scenario analysis and the market scenario structure. So here we have an explanation of what exactly this means. Today's pre-market range, PML to PMH, gaps completely below yesterday's RTH session low. YDL, followed by tendencies and also certain risks to watch out for, reversal watches, continuation, key level priority, gap size matters, the difference between small to medium gap downs and large gap downs, and what difference that plays as far as key level priority. What key level priority means here is the key levels between these 4 key levels, these 4 key contextual levels, not the main key levels. Also, some additional information about rule of thumb, any tips, continuation versus reversal potential, and of course the important note as far as the risk disclaimer here again. Now you can change the size of this table. For example, it does show up as normal as the default. However, you can go down here and you could change it as an example to small, and you can see what a difference it makes. Now also we provide PDF one-page cheat sheets for all these market scenarios. The one-page cheat sheets provide additional information than what we can have here because there's just simply not enough room here to put every single thing. So all of the core information, all of the core necessary information is here. However, the one-page cheat sheets also have some additional information on them. Now the one-page PDF cheat sheets are found on a Google Drive link in your user guide and manual. And we'll go ahead and show you those right now. So what these can be handy for is studying them off screen. If you'd like to just study them in some downtime. You can also keep them as a PDF on your computer. You can certainly download it to your computer. You can also print the sheets out. If you download it to your computer, if you have a second monitor, you could simply put up the market scenario for today on your monitor if you don't want to have the market scenario analysis table on your chart, as it does take up quite a bit of room. But it is necessary to have on your chart because sometimes you may not have the PDF cheat sheets available for whatever reason, and so at least you can always go back to having the analysis on your chart as a quick reference as well. So now we'll look at the PDF cheat sheets. Okay, so here are the PDF cheat sheets. You basically have a cover page followed by each one of the sheets. As you can see here, it says, please note all sheets are in 8.5 by 14 format. So if you're printing these out, please adjust your printer to print 8.5 by 14, not 8.5 by 11. You may want to set these to 125% or 150% for easier reading once we start taking a look at them. So it starts off here with a summary, just goes through what each one of the scenarios are with an explanation of each, followed by the important note and risk disclaimer, which we already went over. And then we have these, which are all color coded. It starts off with the structure, an explanation of the structure, visual explanation of the structure, primary tendency, key trading characteristics, what to expect. Some of them have more information than others. It just depends on the particular scenario. Here we have the full gap above. Same thing. We have a bias, tendency, key trading characteristics, key level priorities, additional characteristics, and some additional tips here. Same thing with full gap below. Market scenario 4, top overhang poke above. Tendency, key trading characteristics, what to expect, common patterns, critical tests, tips. Bottom overhang poke below, primary tendencies, tentative bias, key trading characteristics, what to expect, and an additional tip. Finally, market scenario 6, the most volatile of all the market scenarios. This is where the pre-market high and pre-market low range is outside of the entire yesterday's YDH YDL range. So this means that the pre-market low is below YDL and the pre-market high is above YDH. So this is the most volatile of all of the market scenarios. Generally, this is a market scenario which you want to exercise a lot of caution in. You can make a lot of money in market scenario 6 as it is extreme volatility, so you're going to get whipsaws up and down until the market finally decides on a particular direction that it's going to go in. So it does provide a lot of day trading opportunity. However, it also can provide a lot of need for caution because it is typically a lot faster moving market than normal. A lot of whipsaws, a lot of stop outs typically. So we have here risk warning. Additional risk warning here with this particular thing. Wide overnight ranges often see retail traders trap while professionals exercise caution. Trade management is extremely critical in this volatile market scenario. If you're going to trade at all, then consider reducing position size and widening stops. So again, primary tendencies, key characteristics, what to expect, tips, etc. So again, you can download this to the Google Drive link. You can print them out. You can save them on your computer, look at them on a separate screen. And this provides a nice visual reference to go to if you don't want to use the market scenario analysis table on the chart. Okay, so let's go ahead and we will just make a note here. That's something that we're going to show you later. We're just going to bring this back up to normal size just for a second. So as an example, gap fill attempts. Market often rallies towards YDL to fill the gap. So we can see in this particular session, we'll just go through this real quick before we go on. This particular session of April 2nd is more of a textbook of this particular scenario. So as you can see here, severe gap down, followed by a move back up to YDL. In this case, it actually tried to get all the way to YDH, went up to YDC. When we go through the trading section later, then we'll see not only the trade setup here for this particular session we'll go through, also how to use additional ribbon indicators to confirm trade entries. We'll take a look at a free tool, free ribbon indicators that are available on TradingView. We're also coming out with our own ribbon indicator. We haven't quite finished it yet. We'll show you that as well. It does have some advantages over the other ribbon indicators, especially if you're using on indexes such as NDX and X and SPX. It will, however, not be a free indicator. It will be a paid indicator, unlike the other ones that are free. However, if you prefer using the free ones, that's fine as well, as we do have several videos on using the free ones, and the free ones are good in most cases. However, there are situations where they cannot be that good, especially on indexes where you have severe gap ups or severe gap downs, as we will see later when we go through that section. Okay, so we're back here and we have the market scenario analysis table. You can change the placement of the table here. It has a little bit more options than the other tables. So you can put it in the center, you can put it to the center left, center right, or top center, or put bottom left, bottom right, etc. You can also change the colors of the table if you prefer different background colors and different text colors. Next, we have market scenario labels. So if you click on show current market scenario label, then you will see here on the current candle, you'll see a market scenario label. This is meant, for example, if you don't like having this table on the chart, but yet you do want to be notified of what the market scenario is without turning the market scenario analysis table on. Also, you have show historical market scenario labels. That comes in handy with as part of the historical session tools, as you'll see later when we get to that particular section and go over that in more detail. And you can also change the size of these labels. So I'll just show you that real quick. It's around normal right now. You could make it larger or smaller. So we'll just show. Or you can make it smaller. Normal is what it's set to as a default. You also you can change the text color. You can also change the background color. So for example, if you wanted to make it yellow, you could make it yellow. Okay. So now we've come to the end of the user control panel, and now we'll move on to the other topics. Okay, so now what we're going to do is we're going to go over a general overview of how to trade using the Nasdaq NDX Daily Key Levels V3.0 indicator. Okay, so in the user guide, you do have a section on trading with the indicator. So this is a fairly long section that goes into all the different aspects of using our daily key levels strategy, and it also goes through trading all from the different levels, either the bull bear key price level, the R levels, the S levels, or the 5 contextual levels. It goes through stop loss, trade entries, target exits for different types of trades, scalp versus regular trades, option strike selection, etc. So we're not going to go into every different small detail of that. In this video, we're just going to go over a general overview. You can look at the user guide and manual for more details, and also look at the session videos. Most of our session videos on our channel are for the SPX uh, daily key levels indicator, but it works the same way with the Nasdaq NDX daily key levels indicator. So some of the links that you'll see in the Nasdaq NDX user guide and manual, some of the YouTube links will be on SPX session videos, but just know, as noted in the manual regarding those, that the core concept is the same with the Nasdaq NDX as with the SPX indicator as far as trading. Okay, so of course the NDX session opens up at 9:30 and it runs till 4 p.m. Eastern time. So the market opened 9:30 a.m. Eastern New York time, and the close of the index is at 4 p.m. Eastern New York time. So this indicator again is made for day trading. It's not meant for swing trading. That means that you are opening and closing all of your positions all in the same session. So with that in mind, as far as the types of options that you would use would either be 0 DTE or 1 DTE. And the reason is that there's really no reason to use more than 1 DTE if you're going to be opening and closing the positions all in the same session and not holding them over from session to session, because anything over 1 DTE, you're simply paying more for time, which is not going to be necessary past 1 DTE, because then you're just paying excessively for more time, which is not going to be relevant. There are, as pointed out in the user guide, there are some reasons why you may want to use 1 DTE over 0 DTE, especially if your preferred strategy, at least for buying options, as opposed to selling them. Keep in mind our daily key level strategy is based on buying options. We're not doing credit spreads. We're not doing iron condors or any type of selling strategy where we're receiving a credit for selling options or a combination of options and then buying those back at later to close them out, and keeping a portion of the credit that we received at the beginning. These are uh, debit strategies in which we are buying either calls on bullish trade entries or buying puts on bearish trade entries. So with that in mind, one of the advantages of 1 DTE options is that if you're going to be holding these options till later in the session, let's say that you are going to be that your preferred strategy is buying them sometime earlier in the session and holding them either into the close or into the later part of the session to try to get the maximum moves, especially on your remaining runners. The problem with 0 DTEs for that is later on in the session, especially after say 2 or 2:30 p.m., is that if price starts moving against you, the amount of the decrease in your profits will be a lot more rapid with 0 DTE, simply because they're expiring at 4 p.m. that day versus 1 DTE 4 p.m. the next day. So that's just something through practice and trial as far as figuring out whether you prefer to just trade options in the morning, opening and closing your positions typically before lunchtime, or are you more of a trader that prefers holding until much later in the session, and then you can figure out if you have a preference over using 1 DTE for that purpose versus the 0 DTE. Okay, so let's just get right into it. As pointed out in the user guided manual, so we try to use additional indicators for confirmation of entries from the cross and close above or cross and close below candles on the different key levels. So we're going to look at 3 different ribbon indicators in this particular video and show the differences between them. And then, so we'll just start off here with the 9:30 a.m. Opening candle here. So let's just go ahead into the user control panel. Again, we already went over some of this earlier, but we'll turn on the BBKPL opening alert, apply the range filter, which again is set at the default at 85%. And as you can see here in this particular session, we had a very large gap down from the close from the previous day. This candle did close, this 9:30 a.m. opening candle here did close above the bull bear key price level. However, it is out of range. It is out of the acceptable range because it is closing more than 85% of the 1 level base. So this is closing more towards, say, somewhere in the 90s here. So that's why there is no alert here on this particular candle for a BBKPL bullish alert. Now let's go ahead and we'll bring in our ribbons here. First, we'll look at Annie's ribbon, which is this one here. So as you can see here, this is a moving average ribbon indicator. This is a free ribbon indicator on TradingView. It does have quite a few moving average bands, and then it has these 2 thick moving averages within all the bands here. As you can see here, when it is all red, such as this, this is a bearish bias. Then you'll see as it starts to reverse here, we start getting some green bands on the bottom. Eventually, it retraces back up to the bottom moving average, touches the top moving average, and eventually breaks through and then turns all green here, and then pretty much stays above the top moving average here. The second free one is the Madrid ribbon. So this is one of the original ribbon indicators. Basically the same type of indicator, very similar to the other one. However, you don't have the 2 thick yellow moving averages like you do with the Annie's ribbon. So we'll go back and look at that just briefly. So you don't have these here, which are an additional guide. So out of the 2 free ones, this is probably the the preferred one because of this additional feature here. And it does have a couple of other little nuance differences than the original Madrid ribbon. It basically follows the same pattern here, but as you can see here, one of the concerns with using a ribbon indicator in a market such as an index where you don't have the overnight or pre-market action is that if you have a very large gap down or a very large gap up, then you're going to have a situation like this where even though we started getting a move up here off of this gap down and move back up to YDL and eventually up to YDC, the ribbon is staying mostly a red, even though we had quite a point move here. And the reason for that is because of the severe gap and how this gap affects these types of ribbon indicators. So we have our own ribbon indicator that we developed that basically has a filter on it that will take into consideration these large gaps. So we'll take a look at how this one is different. So this is the day trading GPS ribbon indicator. As you can see here, well, we've turned it on. We've turned it on, and it does have the NDX SPX index filter on, which compensates for large gaps. So as you can see here, even though it does start off red here, it does eventually turn green down here, and then you're able to take advantage of this particular run here on the break above, and then the ribbon turning all green here. Versus if we turn this filter off, then you have basically the same situation. So you can see here that with the filter turned off, you have basically the same situation as with the other ones. So with the filter off, this can be used on regular, stocks, ETFs, futures, etc., markets where that do at least have a pre-market. They don't necessarily need to have an overnight market, but at least if they have a pre-market, that's for a decent amount of time before the RTH market open, then the ribbon can reset. It has enough time to reset for that particular session. However, in the case of indexes, when you have a severe gap down or a severe gap up, then you get a situation like this, which can throw the ribbon off. We turn the filter on, and then as you can see, we have a completely different perspective here. So this filter is going to be more effective on, say, gaps that are medium to extreme. On smaller gaps, it's not going to make a whole lot of difference. So on smaller gaps, using the free, one of the two free ones, the Annie's ribbon or the Madrid ribbon, or using this particular one without the filter, is typically going to be fine. It's really more you get into the medium to large or extreme gaps where it can make a huge difference. And of course, with indexes, basically every day is a gap, going to be a gap situation because of the fact that there is no pre-market or overnight action in SPX, CBOE, or Nasdaq NDX. Okay, so without the ribbon, you have no entry here because we have no signal here on the 9:30 a.m. opening candle. So there would be no trade here. You come down here, we have a 1 bar close below the bull bear key price level, and then we're getting basically sideways action here where we get a close above and then a close below and then finally a close back above. So that's why it's helpful to also have the ribbon indicator to help you to gauge the entry. So for example, we go back to this ribbon indicator here, and we'll drill down a little further into this here. So basically here you have the ribbon is red here. Okay, well what we're looking for is we're looking for confluence with the ribbon as well as the close above or below the key level. Okay, so what I've done here is I have changed the candles so they're a little more translucent so you can see the ribbon better, rather than having them as solid blocks where it can block out part of the ribbon. So basically, to do that, you go to the you go up here, click on Settings, go to the symbol. You have candle. So the body of the candle, we've made the opacity of this a lot less. So if I for example change it back to where it was 100 on both of these, as you can see, it pretty much covers up the ribbon. You can't really see the ribbon very good when it's like that. So one thing you can do is you can go in here and you can say go back down to say something below 15. So we'll just make it on 10 as an example, and then 10 on this one. So now you can see that basically here is where we have all red. The ribbon is all red here. So this would be a bearish trade opportunity here on a close below the R1 level. And then we have a move back to the BBKPL. On a scalp trade, you're looking for a one level move in your favor. The one level move in your favor is calculated from the level that you're basing the trade on, and then you look in the direction of the trade, and one full level down from the R1 level is the BBKPL. So this would be a successful scalp trade here as it does move down one level. And of course, if you used the other ribbon, you would have the same situation here because the ribbon is all red and you're looking for, again, the close below the level. And then on a scalp, you're looking for a one level move in your favor. As you can see here, though, we do have this now turning gray, so the ribbon is all red here, however, it's not all red here. Now, if we go back to the other one that has the gap filter, you can see here, this one, it's actually green here on this one. And then here. So we have a multicolored one here when it gets down to the bull bear key price level. Now, if this had continued down further, then the ribbon would have then turned all red again. If we had a successive close below, and that successive close below was still within the acceptable range of 85% or less, then if you did not take this trade here, then the next trade opportunity would have been a bearish trade off the bull bear key price level of a close below within the acceptable range and the ribbon being all red, not having any green in it. So outside of this trade here, you have this close above the bull bear key price level here and here, but as you can see, the ribbon is not all green yet. We still have a multicolored ribbon that's partially green and partially red. It does not turn all green until this candle here. So on this candle here, this is the R1 level. So if we move this back where we can see the levels as well, you have the close above the R1 level here. The ribbon is all green, and this candle close is also above these two thick moving averages with lines within the ribbon. So this would be the first bullish opportunity here. This would be a trade off of the R1 level, a bullish trade. And then you would have your tight stop loss is the QL below R1, the level you're basing the trade on. And then your standard stop loss would be the first midpoint below this level, the R1 level. Then we have a move up to the R2 level here. This would be your scalp only exit, a one level move from R1, the level you're basing the trade on, to R2. A regular trade is a 1.5 level move in your favor. The regular trade differs from the scalp trade in the perspective that on a regular trade, you're primarily looking for an extended move in your favor over the scalp trade. And then one of the biggest differences on a regular trade is that you have several different options for how to manage your trade or close out your trade at the minimum 1.5 level threshold move in your favor. So the 1.5 level threshold in our favor from this trade, it's based on the R1 level. R2 is the scalp. Next midpoint above is going to be the mid R2, R3. So that's one level and then 1.5 levels. So at the hit of the 1.5 level move in your favor on if you're doing a regular trade, the options would be either A, you could still close out the trade 100%, no matter how many options that you're trading, just like you did with a scalp, except you're going to have more profit because now it's a 1.5 level move in your favor. So that is the first option, is just closing out and exiting all of your position at the 1.5 level move in your favor. The second option is to still hold, is to not close out any of your options, but instead change your stop loss from a level-based stop loss, which in this case you are either using this level here for your tight or this for your standard, then changing it to a price of the option-based stop loss, how much you paid for the option, and then what you're doing here is you are changing your stop loss to break even the price you paid for the options, or break even plus a small profit buffer. The small initial profit buffer would be somewhere between 10 to 15%. Of course, the exact amount that you want to use is up to every trader. You may find that you prefer using a smaller amount, such as just a few percentage points, or you may find that you prefer for your purposes to use a larger amount than 15%. The reason why 10 to 15% is that's a decent amount of profit to still have should price retrace back down and hit your stop loss. You're still going to be out with a small profit, but it's not so large as to make it to where there is a majority chance that it's just going to go ahead and get stopped out. So one thing you have to keep in mind, if you're going to add anything, a profit buffer on top of break even at this initial 1.5 level threshold, if for example you put a 50% profit buffer and kept all of your contracts, it's a very high likelihood that that is going to get stopped out because it's simply just too much of a profit buffer. And the way the markets typically move is that you'll get a significant move up and then you'll get a retrace, and then you'll get a significant move up and then a retrace, or you'll just get a controlled stair step move up where it ratchets up some and then it'll ratchet down a little, then it'll ratchet up some and then ratchet down a little. So rarely does it just keep going and never retrace. There are some days like that, but for the most part, that's not really how it works on most days. So that's something you have to keep in mind. If you put too much of an initial profit buffer, then you're really just better off instead of, like, for example, if you were more inclined to say put a 50% profit buffer initially on top of break even, you might as well just close out all of your contracts instead of doing this profit buffer. You're better off just go ahead and closing out, because probably what's going to happen is you'll put the 50% profit buffer on there and then you'll just end up getting stopped out, and then you could have had a lot more profit by just going ahead and closing out all the contracts at the 1.5 level move instead of losing half of that profit on the stop out. The other option that you have would come into play if you are trading 3 or more contracts. So on Nasdaq NDX options, of course, they are fairly expensive because the Nasdaq index is several times more expensive than the SPX index. So consequently, the options are going to be a lot more expensive than the SPX index. So typically, you have to have a very sizable account in order to just trade a fraction, risk a fraction of your account to buy multiple 3 or more NDX options. So you would have to have a pretty sizable account in order to trade 3 or more options, where that purchase of 3 or more options is only going to represent a small fraction of a couple of percentage points of your account as far as the risk on those. But for those that do, then if you are trading 3 or more options, then the other alternative at the 1.5 level move in your favor is to close out and exit somewhere between 60 to 90% of your options at the 1.5 level minimum threshold move on a regular trade. You would be closing out 60 to 90%. So for example, if you were trading 3 and you closed out 2, that's roughly 66%. If you were trading 4 and you closed out 3, that's 75%. If you were trading 5 and you closed out 3, that's 60%. Trading 5, closed out 4, that's 80%. If you had 10 as an example, just to make a round number, that would be closing out somewhere between 6 and 9, 60 to 90%. So the point is that you are closing out the majority of your position, not half of the position of 50%, which is why 2 doesn't really work as well. If you do use 2, you just have to keep in mind that that's not really how this is designed, so it is better to use 3. If you do use 2 and you closed out 50%, then that would still be okay. It's just not as ideal as trading 3 or more. So the idea here is that you're closing out the majority of your position and at the 1.5 level move. And then what you're doing from that point on is that you are managing the remaining runners. And with the remaining runners, after you close out the 60 to 90%, at the same time, you're changing the stop loss on the remaining runner position to break even, the price you paid for the option, or break even plus a profit buffer. So that way you've taken out the majority of the profits on the trade that you've secured, and then now you've de-risked the remaining runners because you've now changed the stop loss to the price you paid for the option, break even, or break even plus a small profit buffer. Then the idea after that is that with the remaining runners, you are then managing them level to level. So what exactly do we mean by that? What that means on a regular trade is that after the 1.5 level move in your favor, which at this point is the mid R2, R3 level, at every continuing key level after the 1.5 level move in your favor, each of those becomes an additional waypoint for a decision that you are either further adjusting the stop loss on your remaining runners by adding an additional profit buffer, or you are exiting some or all of your remaining runners on the additional move, key level move in your favor, or you're doing a combination of both. So it really just depends on how many remaining runners you have. For example, if you had 3 remaining runners after this, let's say that you traded 10 options as an example, and you closed out 7 here on the hit of the 1.5 level move in your favor. Now you had 3 remaining runners left that you had adjusted to the break-even stop loss or break-even plus initial profit buffer. The next key level move up is the R3 level. So at that, you could sell one of the remaining three on runners on the hit of this R3. Then on the remaining two runners, you could either leave the stop loss the same as it was from the initial adjustment, or further adjust the stop loss on the remaining two to increase the profit buffer on those. Then on the hit of the next key level, which is the YDC level, because the YDC is happening after the 1.5 level move in your favor, it's also an additional key level that is occurring after the 1.5 level move. Then you would also have a this as an additional point here. So when it hits this, it just so happens in this one candle it took out both of them. So in this case, in the close of this candle, it has taken out both of them. So in this particular session, this just would have been one decision here, unless you wanted to, if you're going on candle closes, if you're just going on touches of the level, then you would have two different opportunities here, because that was happening intra-candle. So that's, again, something that each trader needs to decide for themselves if they want to do exits and adjustments based on a touch of the level, which can happen inter-candle, or are you waiting for the close of the candle to then do your exit or adjustment. So that's just something every trader has to decide for themselves, which of those two methods that they prefer through use and practice. Then after that, what you're doing is we would go ahead, once we started seeing this up move here, what you would do if you don't already have the additional midpoints turned on is that you would go into here and you would turn on mid R3, mid R4, R5, mid R5, R6, because you don't know how far up this is going to go if you're doing a regular trade. So that's something that you can't really predict beforehand. It just happens if you're going to get, an extended move, because you don't know if news is going to come out or what exactly is transpiring in the market on that day that may cause a more of an extended move. So you would turn on the mid R3, R4. So if price had moves from the YDC up to this level, then the midpoint levels also count as additional waypoints for decision making if they occur after the 1.5 level move in your favor. So here's the 1.5 level move. So this main key level is additional waypoint happening after 1.5 level. The YDC is the same thing. It's happening after the 1.5 level move. This midpoint, the only thing you're not going to count is QL levels. So QL levels do not count in this. Only midpoint levels, main R or S levels, and any contextual levels that occur after the 1.5 level move in your favor. So you would then have, after this, you would have this one, then this one, then the next midpoint, and then the next main key level. So if you were still holding on to some runners that at each one of these hits, at each one of these levels, you are either adjusting your stop loss on the remaining runners further, or you're exiting some of your one or more of your remaining runners, and then doing either leaving the stop loss the same on being break even, or break even plus the initial profit buffer on the remaining ones, or adding more profit buffer on any remaining ones, until finally you get down to the last remaining runner position, and then at one of these points you are deciding to exit that final runner. So if price starts going sideways and you start seeing, for example, the ribbons start turning the other color and start closing below one of these lines or both of them, then that can be a signal, if it hasn't already hit your stop loss, to perhaps exit the remaining runner. Okay, so what about strike selection? So strike selection is done as follows. So you have three different strikes that you can utilize on trades from any one of the main key levels, the bull bear key price level, the R levels, or the S levels. So on bullish or bearish trades from any one of those levels, you basically have 3 different strike options on any given trade. So how you figure that out is as follows. This was a bullish trade from the R1 level. Remember, these were our stop losses here on this trade for the initial trade entry. So there's basically 3 option strikes that you can do. One is the standard play. The standard play is going to be the option that is closest to, the strike that is closest to the R1 price level. So on NDX, the option strikes are in 10-point increments. On SPX, they're in 5-point increments. So on NDX, you have 23,647.64. So the 23,650 strike is going to be the closest because it's either 23,650 or 23,640. So this is across the midpoint between the 640 and the 650. And so in that case, you're going with the 23,650. That would be your standard play call option on this. The second option that you have is out of the money. The way you figure that is you look in the direction of the trade. In this case, this is a bullish trade, so we're looking up. Go to the first midpoint above the level that you're basing the bullish trade from. Mid R1, R2 is the first midpoint above. 23,706.42. So that's going to be between the 23,700 and the 23,710 strike. This is closest to the 23,710 strike. If, for example, this was right in the middle, let's say it was 23,705 and it was exactly in the middle, you could use either strike 23,700 or 23,710. My preference is to defer to the higher strike, or the which in that case would be the 23,710. So if it was 23,704 something or 23,703 something, you would use the 23,700. If it's above and it was 23,706.42, like in this case, then you would do the 23,710. If it's right in the middle and it was exactly 23,705, you can use either one. Probably the difference would be going with the lesser priced strike, which in this case, for this particular trade, would be the higher strike, the 23,710. If this was a bearish trade instead, then it would be deferring to the the lesser priced strike, which in the case of a bearish trade would be the lower strike. The furthest out of the money strike you can consider on this trade is going to be one full level away from the level that you're basing the trade from. So in this case, the R1 bullish trade, one level up, is the R2 level, 23,765.19. So this is slightly over the midpoint between 23,760 and 23,770. So you would go with the 23,770 strike. Now with NDX, because the options are so expensive, one thing you can also keep in mind, and this is not in the user guide and manual, so this is just something else you can think about if you're trading NDX options, is that if you're trading in the morning part of the session, then one thing you can also consider doing is you can go up even to a second full level up or a 1.5 level move up, and also consider using those strikes if you're looking for something that's a lot less expensive. Because again, with SPX, we wouldn't be doing this. this would only be something you would want to consider possibly doing with NDX. You would just need to, again, practice this on a demo account to see how it works out for you if you're trading in the morning part of the session, especially if it's 0 DTE options. And you could go up to a 1.5 level or 2 level move away. In this case, you could consider the 24,000 strike, or with this, the 23,880 strike. So these options will be a lot less expensive than the other ones that we would normally use, especially with SPX. However, you may find that with NDX, if you're trading in the morning, you may be better off using these if price is a big concern. As in the morning, these will still be fairly expensive, and if you're trading where you're opening and closing a position in the in the morning part of the session, these can also work out as well. But again, you just need to practice through trial on a demo account to see how utilizing these that are further away, 1.5 level and 2 level moves away from the level that you're basing the trade on work out versus the other ones. So I would only consider that after doing kind of an extensive trial on your own to see with NDX how that works out. Again, on SPX, that's not something that we would consider doing on SPX. Only on NDX, only because the options are typically a lot more expensive than SPX. As again, this is trading at 24,000. SPX is trading at approximately 6,500, so it's almost 4 times as expensive as SPX to begin with. Okay, one thing to keep in mind is that regardless of what strike that you're using, the initial stop loss on your trade entry is going to be the same. So in this case, if you're using a tight stop loss, QL below R1 on this bullish trade from R1, or the midpoint below R1 if using the standard stop loss. So regardless of which strike that you're using for your option, the initial stop loss is going to be based on the price levels, the QL or the midpoint in relationship to the level that you're basing the trade on. However, when you're adjusting your stop loss, as we talked about earlier, then you're adjusting your stop loss to break even to the actual price that you paid for the option. You're no longer using the price levels. And then obviously, if you're adding a profit buffer, you're adding an additional amount on top of whatever the price was that you paid. So an additional amount on top of break even. Now, what about trades from the contextual levels? So again, if you were not taking this R1 trade as an example, then the next opportunity here would have been a close above the PMH level, with the ribbon also confirming green here. And again, we're using the day trading GPS ribbon indicator. Now, just something to throw in here that we have not released as of today. Today is Friday, April 3rd. We have not released this indicator yet. There are some things we're also considering adding to it, so we have not released it yet. This indicator more than likely is not going to be a free indicator. We may end up including it with purchases of lifetime access to the indicator as opposed to monthly, quarterly, or annual access, or we may just sell it separately, either also making it available on a monthly, quarterly, annual, or lifetime access basis. We have not decided that yet. Once we have finished putting any final touches on the indicator, then we'll make that decision at that time. And then we will notify all the people who have bought the NDX indicator or one of our other indicators. Okay, so on the contextual levels, the PML, the PMH, YDL, YDC, and YDH levels. So again, you have the closed above the PMH. Within the acceptable range, the ribbon is all green. So in this case, let's say, for example, you wanted to take a bullish trade off of PMH, you didn't take the trade off of R1, then these trades are done differently as far as the stop loss, as we pointed out earlier in the video. So you simply go into the user control panel, and you can do this in advance if you're anticipating taking a trade off of PMH, possibly, if price action happens to dictate that, or let's say you normally like taking bullish or bearish trades off of a certain contextual level like the PMH, you can go ahead, excuse me, and turn on the stop loss and take profit for that in advance should price action dictate and provide that opportunity. So you don't have to do all this, after the fact. You could do it beforehand, just setting it up in case it does happen. So just keep that in mind. All right, so we go to the bullish entry. So it starts off here with PML. The next one is PMH. So let's just say here, and let's say we wanted to do a tight stop loss. Then you're going to see here would be the tight stop loss. So bull TI, that stands for tight stop loss PMH level. So this would be your stop loss on that trade if you're using a tight stop loss. If instead we changed it to a standard stop loss, then that's where it would be here. We'll go back to the tight for now. So you're definitely using this for the stop loss. Now you don't necessarily have to use the take profit part of this section for your take profit. What you could do is that you could instead use key levels for your take profit. And on these types of trades, what you'd be looking for with the contextual level trades is you're just looking for the next key levels up. So this R2, as an example, could be your scalp only exit. Then you could look at a regular trade as being the next key level above that. And then again, you would look at each one of these as, if you're doing a regular trade, each one of these levels that's happening after the second level as additional waypoints for decision making should you be inclined to scale out and then manage remaining runners. Now the other way of doing it is that you can instead use the take profit reward risk multiplier. So if we turn this on, the default reward risk multiplier is 2, so that means $2 of reward for each dollar of risk. The dollar of risk is the amount of distance between the level that you're taking the trade on and the stop loss. So this amount here is going to be double the distance of the stop loss. So as you can see, if we change this to a standard stop loss, then it's going to increase this because now the standard stop loss has an increased distance. We go back to tight. So this is really going to depend on a couple different things. You could use this as, you could ratchet this to a specific level, either a specific price level in general, regardless of where the key levels are. Let's say if you just wanted to get out at 23,800 as an example, then you could simply just keep ratcheting this up by 0.25 point. This goes in 0.25 increments. So if we do that, now we're at 761. 768. We'll move it up a couple. 783, 23,798. So that's a 3.5 reward risk here. 23,798. That's right before 23,800. The reason is that you have whole numbers, so that's one thing you could consider when using these contextual levels as a whole number exit. You could also just go slightly above. 3.75 would probably put it slightly above the 800. Typically, if you're going on a whole number thing, such as 800, 700, 600, stuff like that, you probably are better off doing a one where it's going to happen right before the number just to make sure that you're able to get out. So doing this would generally be the preferred play, as that way you're getting before it hits that. So if it's going to a magnet to be like a 23,800, then you're having this trigger the exit or adjustment based on just getting there right before that. The other way is just basically aligning it with a specific level. So let's say, as we noted with the market scenario analysis for this particular session, that on this type of market scenario, it has a tendency to seek out the YDL level to try to close the gap from the day before. So in this case, if you wanted to do that as the strategy and get out at the or target the YDL level from this PMH bullish trade, then you could simply ratchet it up to get near or right at or right above YDL. So let's say we make it 4.5, and you would just keep ratcheting this up until it gets to around the YDL level. Okay, so as you can see at 5.75 reward risk, we're just right under the YDL. So if you were targeting the YDL, this would be a good place to set this. So 5.75. So again, as I talked about earlier, you could set this up in advance if you're looking potentially, let's say you're just going to sit and wait for a potential close above PMH going to YDL trade. You could just go ahead and set this out in advance and just wait to see if price action and the confirmation from the ribbon actually presents the trade opportunity, and then you've already got it mapped out in advance, ready to go. If we make it an even 6, then as you can see, it's basically right on there. We go to 6.25. Then we're basically right at this midpoint level. Now keep in mind, this is on a tight SL. If we were on the standard SL, then this would be roughly half of that. So if you were using the standard SL, then using a 6.25 is going to put it all the way up to here, which, as you can see, it actually did hit that. So, but going back and changing it there, if we're just going to go down and see where on a standard SL it hits, then we would back it back down. That's where 3.25 is. If we just go to 3, it should be basically right about there. Okay, so on a 3-to-1, on using the standard SL, we're basically right at YDL. Okay, so we'll go ahead and turn these off now. We'll go ahead and turn this off as well. Okay, now what about strike selection when you're using these contextual levels? It's basically the same concept as the other ones, just have to look at it a little bit differently. So remember on these we have the built-in preset levels for each one of these R and S levels in the BBKPL to go by. In the case of the contextual levels, it's a little bit different. So as far as the standard play, it's going to be the same exact. You're basically looking at the strike closest to the contextual level. So in this case, a bullish trade, 23,695.14. So the 23,700 strike, since this is slightly over the 5, the 23,700 strike is going to be the closest strike to this level. So that would be your standard play. As you can see here, the first midpoint above is basically very close to this level, so you would not use that. You would simply go up to the next available key level. In this case, 23,765.19. So again, that's slightly over 5. So that would be the 23,770 strike. Then if you wanted to use a further out of the money strike, especially if this is the level that you're targeting, you could use a strike closest to the YDL level, 23,871.61, so that would be the 23,870 strike. Okay, so for the rest of the trading section, we just go back and look at the user manual. It is a pretty extensive section here, so just go back and look at the different section here. It starts on page 14, goes on for quite a bit in the manual. So just look at that, and then you could review the more of the session videos on our YouTube channel for SPX and some of the prior ones for NDX. Okay, so now we'll just move on to the next section. Okay, so now what we're going to do is we're going to look at using the historical session tools with the indicator. First of all, we'll just get out of this replay mode. Next, we're going to reset the settings back to the default. We'll just get reset settings here. Okay, so there is an extensive section here in the user manual on the market scenarios. So as a precursor to this, you need to look at the market scenario analysis and the importance of market scenarios. Okay, and then we're going to go to historical levels display. There's a couple pages on historical levels display and the importance of historical session analysis and how it can help you refine your trading and improve your trading. We're not going to go over all the aspects of that. You can read through that. What we're going to go over here is how to set up your chart for looking at historical sessions. Okay, so what we're going to do first, we're going to go into the user control panel. So what you need to do is you may need to make adjustments to the settings here in order to be able to look at your chart properly using historical sessions. So one thing you need to do is first we're just going to get rid of the tables on the chart. So we're going to uncheck all the tables. Next, we're going to go in and we're going to change all the lines to right only that are set on both. So you do all three of those there. Then you're going to move down to the pre-market levels and yesterday's levels. Change that from both to right. On the previous daily lines, the YDH YDL YDC, you don't have to do that because those are hard-coded to be right only. Now, as you can see here, now we're on right only. Next, what we're going to do is we're going to turn on the historical options. So we're going to go down past the QL levels, enable historical BBKPL line, show historical R&S lines, show historical midpoint lines. Now we don't have historical QL lines, so it's only historical BBKPL, historical R&S, and historical midpoint lines. Next, we go down to pre-market values, enable historical PML, PMH. Next, we go down to the YDH, YDL, and YDC lines, enable historical. Finally, we go down to the market scenario label. Show historical scenario labels. One thing you need to keep in mind with historical sessions is that there are not historical line labels. There is a couple different ways that you can differentiate certain levels since you will not have the line label text. As you can see, they all have their own line width, line color, and line style. So that is one way that you can make them more prevalent here to make them more easily recognizable on historical sessions. So as you can see here, every historical session now has the market scenario label. Now, if there's a little hard to read, you can go down and you can increase the size of it. So they're set to normal. For example, if we set them to large, especially if we're looking on a smaller time frame chart, such as that, you could make them large. Or if you don't like that look, then you can simply go back and change it to normal. Or if you want to make it smaller than normal, that's up to your preference. But right now, we'll just change it back to the default. All right, so let's go back to the previous point where we're talking about the line style, line color, and line width for these basic levels here. So let's start off with PMH and PML. So PMH is this bright green color and PML is this bright red color. Now, the PML and PMH, as you can see, it's fine when you have it on a current chart in the current session because we have these line labels. However, if we don't have these line labels, then as you can see, this is basically the same color as these S levels, and then this PML is the same color as these R levels. So when you don't have the line labels, it can be a little confusing when you're looking at it here. So what you want to do on historical is you can go back and you can change the colors, line style, and line width for those particular ones. So let's say if we want to do that for the PML and PMH. So let's say as an example, we want to change the PMH to, let's say, a light green, and the PML to, say, a light red. Then we'll also change these to where the width of the line is, say, 5 for each of these. So now you can see this is a little easier to tell where exactly these lines are, because this is the pre-market high, this is the pre-market low. They're a lot easier to pick off now. Another thing you can do if you want to make it one step further is that we can go and change the actual line style. So as an example, we go here and change the line style from solid to, say, dashed on both of these. So now they're even a little bit easier to discern. So basically the idea is you can do that with other lines as well. Let's say as an example, you are more of a person that likes to do bull bear KPL bullish trades, and you're concerned about looking at whether it hits the midpoint below for the stop loss, whether you're going to get stopped out or not. One thing you could consider doing is changing the color of that line. So mid BBKPL S1 would be your stop loss on the bullish trade from BBKPL. You could change that as an example to white. And now we have a white, which differentiates it from the midpoint above. You could also make it a dotted line if you wanted to. You could change the line width again if you wanted to. Just the idea is that you can change these around to make them more easily discernible on looking at historical sessions. Let's say if you're the kind of person that you like taking short trades off of R2 or R3, or let's say you like taking long trades off of S2. Well, you could do the same thing here. So we could say S2 instead of making it green. We could make that let's say we'll go with white, and we'll also make it 5. So now we can clearly see S2, thick white line. Let's say we're normally taking a bullish trade off of S2. Then we could turn on mid S2, S3, because that would be the standard stop loss for that. And let's say we can change that to blue, and then we're going to make that a dotted line. This would be the midpoint for that. If you think that is too hard to look at, then you could just simply go in and change it to something different. Let's say we just wanted to change it to white as well and make it a dashed line. So now we have S2, we have the midpoint below S2, which is the standard stop loss. So remember, on a trade like that, you're looking for a close above S2. So going down below S2 and then closing back above may not happen on a lot of different sessions. However, that's not the point of this particular exercise at the moment. The point is that we're just looking at how to configure the sessions for looking at a historical by being able to discern these lines better if you are looking at because on these you're not going to have the benefit of the uh, line labels. So if you're taking YDC, YDL, and YDH trades, you can just do the same thing. You would go down to that section, and if you feel like you want to differentiate between daily high line and daily low line, you could change these to where they're different colors so they're more easily discernible, and then you could make one, say, a different line width than the other, and perhaps change the line style. Okay, so again, you go through this section here on historical levels, review that, and also the benefits, of studying analysis of historical key levels. It'll go into all the different aspects of that and why it can be a benefit. We're not going to re-review that here in this particular video. This was just for pointing out how to do this. Now, one thing as far as setting up your chart to look at it. Now, one thing you do want to keep in mind with historical sessions is that you are going to be limited as to how many historical sessions you can look at by the amount of bars that your TradingView plan allows you to have. So if you go to tradingview.com and you look at the pricing, you'll see that on the paid things, you'll have historical bars. So on the essential, 10,000 historical bars. On the plus, 10,000 historical bars. On the premium, I'll move this up a little bit. On the premium plan, you have 20,000 historical bars. On the ultimate plan, you have 40,000 historical bars. So that's going to be the number of historical bars that you can go back is based on your plan. So it's a function of how many historical bars you're allowed under your plan and how many bars are in a given day. So just remember that on indexes such as NDX and SPX that trade 9:30 a.m. Eastern New York time to 4 p.m. Eastern New York time, that is 6.5 hours. So on a 2-minute chart, that is 30 bars in a hour. So it's 6.5 hours. That's 210 2-minute bars a session. So if you have 10,000 historical bars available, that's going to be slightly less than 50 days because 50 times 210 is slightly over 10,000. If you have 20,000 historical bars, then that's going to be slightly under 100. If you have 40,000 historical bars available, then that's going to be slightly less than 200. There's 250 or so trading days in a year. So at the 40,000 historical bars level on a 2-minute chart, that's going to be roughly 200 out of the 250, so not quite a year. Now, if you go to a 3-minute chart, obviously in that case, there are 20 3-minute bars in an hour. So that's going to be, say, 130 3-minute bars per day. So you could just figure out mathematically that. If you have a 5-minute chart, it's 12 5-minute candles in an hour. So 6.5 hours, that's going to be 78 in a session. So then you can figure out with 10,000 or 20,000 or 40,000 how many sessions you can look at going back utilizing a 5-minute chart. Then on a 10-minute chart, looking at a 10-minute chart, that's 6 in an hour. So 6.5 hours, that's going to be 39 per day. On a 15-minute chart, that's 4 in an hour. 6.5 hours, that's going to be 26. 30-minute chart, that's 2 in an hour. And so on 6.5 hours, that's going to be 13. and then you can figure it out from there. So it's a function of what time frame you want to look at. Obviously, if you're looking at a 1 minute chart, then it goes down, 60 an hour, and in a 6.5 hour session on a 1 minute chart, you're looking at 390 bars in a session. So just keep that in mind, that that is going to be a function. If, for example, you felt it was very important for you to go back as far as possible, then what you could do is you could switch to the ultimate for, if you felt it was important for you to be able to look back 40,000 historical bars, then you could switch to the ultimate for a brief period of time just to do your analysis, and then switch back to whatever one you want. Or if you felt you want to go to 20K historical bars instead of 10 where you're at now, you could do the same thing, switch to premium for a brief amount of time, then switch back, downgrade back to what it was. So it really just depends on your preference. Okay, so now we'll just move on to the next section. Okay, so the last part of this video, we're going to go over the alerts section. So we're going to go down. So again, here's the BBKPL 9:30 a.m. opening candle close alert. You turn on that, enable the alert, enable candle close above or close below, apply acceptable range filter. It is on 85%. So again, you can set this to something less than 85%. We would not advise you to utilize something more than 85%. Of course, that's up to the individual trader to decide for themselves, but it's recommended to just either leave it at the default of 85% or set it to something that's less than 85%. Here's the alert label size. So it's on small as default. If you change it to tiny, then it's going to be like that. Of course, each one of these, you have to remember that if you do have multiple alerts turned on, each one of these takes up a certain amount of space. So if you have multiple alerts firing very close to each other, the larger that this label is, the more chance of them overlapping. If we turn it to normal, then you can see it's that large. Okay, so let's take a look at the user manual. So this starts on page 10 of the user manual. So you'll go through the types of alerts, settable range filter, goes to certain examples. So you can read through that part. What we're basically doing in this is just show you how to turn them on, and then also how to use this show last alert only. So one thing you need to keep in mind is that the 9:30 a.m. BBKPL alert is a very useful alert to have on. The other alerts can be used for a couple different purposes. One can either be to alert you to a possible entry on a cross and close above or cross and close below a level, for either a bullish entry on a cross and close above or a bearish entry on a cross and close below. But do keep in mind that we're not just going on the cross and close above by itself or the cross and close below by itself, because we're using either the free ribbon indicator or the other ribbon indicator that we outlined, one of the two free ones or the other one, as additional confirmation of either if we're getting a conflicting signal, then we're going to pass on the trade. If we have a signal in confluence, then that would be where we would consider executing that trade, either on bullish or bearish, having the confirmation from the ribbon indicator in confirmation with either the cross and close above or cross and close below the specific either contextual level or main key level, either being the bull bear KPL or one of the R levels or S levels. So again, what we're looking for is we're looking for quality entries. We're not looking for taking every single cross above and cross and close above or cross and close below. That's not generally a good idea. We're looking more for fewer quality entries that give us the best chance of an edge versus just taking every cross and close above or below. Okay, so one thing you want to keep in mind with the other alerts is it really just depends on what your purpose of the alert is. If you are looking at your screen, the actual alerts on the other levels aren't really as necessary if you are able to just stay and looking at your screen. The BBKPL one, of course, is good for the opening candle. What the primarily the result of having the alerts on the other levels is primarily going to be the acceptable range. So if you're not really good at eyeballing the acceptable range that you have it set for, then that can become very useful as far as either you are going to see the alert fire and show a label if it is within the acceptable range, or if it's outside the acceptable range for the particular level that you have the alert turned on for, then you're not going to see a label. So it can be very good in that respect. The other thing you're going to keep in mind is that the lower the chart time frame, the more alerts that are going to fire. So on a 1 minute chart time frame, you're going to see more alerts fire than on a 2 minute. On a 2 minute, you're going to see more alerts fire than on a 3 minute. And on a 3 minute, you're going to see more alerts fire than on a 5 minute. And then on a 5 minute, you're going to see more alerts fire than on a 10 minute, et cetera, et cetera. So on that particular note, if, for example, we go in here and we turn on enable crossed and closed above alerts, let's say we were looking for only bullish alerts. Now keep in mind, if you have the 9:30 a.m. candle is a either or alert, close above or close below, but it's only a singular candle, the 9:30 a.m. opening candle. So that's for a close above or close below. All the other ones you have to do individually, either a crossed and closed above or crossed and closed below. So they're individually set in that respect. So if you're only looking for bullish opportunities outside of the 9:30 a.m. opening candle, then you would just want to enable crossed and closed above alerts. You would not want to enable both of them. If otherwise, you're just going to see a lot of unnecessary alerts. So if you're really only looking for bullish opportunities, then crossed and closed above. So it just really depends on whether you're looking for a specific opportunity above a specific level only and just turn on that alert, or if you're looking for multiple opportunities and you want to see ones for multiple different levels. So for example, if we turn on PMH, pre-market high, apply range filter, then as you can see here, we have multiple ones firing because each one of these is a cross and close above. And going back to one of the things we went over when we were just going through the inputs at the first part of this video is we have this show last alert only. When enabled, only the most recent alert label per key level plus direction is shown. Previous labels are deleted. So this is the decluttering filter. So if this is on, then instead of seeing all of these, you're just going to see the last one. And we can show this by just doing the replay, how you can see how this works out. So we'll go ahead, we'll just start off here. We'll just go one bar at a time. So as you can see, if you have last alert only on, it's going to delete the previous ones and only show the most recent one for that particular level. As opposed to having it off, we'll go back and do the replay again. Now it's turned off. Okay, so it really just depends on your preference as to whether you prefer to have it on and you want to see every one of these, or you want to have it off. Excuse me, if you want to have the last alert filter, show only last alert filter on, and you want it to take them off and only show the last one, or whether you like to have it off so you're just seeing every single one. Me personally, I prefer to have the filter on because I particularly don't want to see every single alert. With the last alert only on, it's going to show you the last alert for every level that you have an alert enabled for. So it's not just going to show you the last alert of any of them and only show one regardless of how many were hit. It's going to show you the last one for that. So to demonstrate that, to get that point home, we'll just go ahead and we will do the R1 level here. Okay, so you can see here we have the filter off. We have all the PMHs. Now we have the R1 close. Now if we go back and we turn the filter on, then you're only going to see this. And we'll just go back and do this on a replay real quick. So as you can see, with it on, it takes the other PMHs off, shows the last one, and then shows you the last one of this. If we had multiple R1s, let's say that this one was also, this one opened and closed above, so that's why you don't see an alert. It did not cross and close above. Then it would have taken this one off and then shown this as R1, if that was the case, if it was another cross and close above. So I hope that helps you understand that particular filter better so you can decide for yourself which one that you prefer. So again, we're looking for uh, confluence. As you can see here again, this was a very large gap up, and this is how the regular ribbon looks, or the Annie's ribbon. You have the Madrid ribbon. Now you have this with the filter turned on. If we turn off the filter, then it looks just like the other ones. If you turn on the filter, compensates for the gap ups, and then you'd be looking at basically this here as the initial opportunity, or this R1 as the first opportunity. So it really just depends on the advantage of this particular one is that it does give you the advantage of having either one, using it without, and of course you would use this without the filter just like the other ones on normal stuff that has a pre-market or overnight like futures or forex, crypto or stocks or ETFs that have a pre-market versus indexes where there is no pre-market or overnight. You can turn on this filter, and that's going to be more helpful in large, medium to large or extreme gap up or gaps downs versus minor ones. Okay, so one thing you do want to keep in mind with these alerts, again, they are separate. So if you want crossed and closed below, you would do this. The difference between, just to clarify this BBKPL alert here, this is going to be for the rest of the session. So the BBKPL on the crossed and closed above and the BBKPL for the crossed and closed below covers the rest of the session. This 9:30 a.m. opening candle alert you would need to turn on if you also want to have the 9:30 a.m. candle. This is only going to be applicable to the first candle of the chart time frame that you have it set on, whereas also enabling these would cover the rest of the session. So if you're just concerned with the opening candle, you would just turn this one on. If you want both the opening candle and the rest of the session for the BBKPL, then you would turn on uh, these as well. So you just have to decide if you want to have both crossed and closed above on as well as crossed and closed below. Just keep in mind that if you have both on, especially if you have multiple levels, you probably really want to have the show last alert only turned on, because otherwise you're going to see, especially on a 1 minute or 2 minute chart, you're going to see a lot of different alerts fire off typically, especially if price is going sideways or in a very narrow range. And that can be kind of annoying, seeing lots of different labels bunched up in a row. It's also not really recommended that you know, turn on a cross above and cross above and cross below on every different level. So I would not recommend that. Of course, it's up to every trader to decide that for themselves. First off, if you do that, especially if you're on a small time frame chart, you're going to see just tons of different alerts, especially again if we're in a narrow range trading market as opposed to something that's highly trending up or down. If you're getting a lot of sideways choppy action, you're just going to see, tons of different alerts, especially when you're on a, let's say, a 1 minute or 2 minute chart, maybe not as much with a 5 or minute or above. And one of the other reasons that you may want to turn on the alerts is also for, if not for potential entries, is for just notifying you when it hits a specific level that you may have for a particular exit. So for example, let's say if we just turn all these off. Okay, so let's say you were taking a PMH trade and targeting YDH, and you wanted to be notified. Let's say that you just want to be notified via an alert when it hits YDH. So after you place that trade, you could simply go in, you place the trade off of PMH. Now, you don't necessarily, if let's say this is for an exit, you don't necessarily have to have the range filter on if you're using this simply for, you want to know when it hits it for an exit. Apply range filter would be more if you are looking at it more from a potential entry standpoint. So let's just say we're just turning it on for that. Then you have cross and close above YDH here. Okay, so just read over the section again in the user guide and manual for this particular section on the alerts. And that is going to wrap it up for today's video. Again, please take a look through the entire user guide and manual before trying to use the indicator. And again, just one last note, we'll go into the manual here. And if we go to page 4, important note on practice trading on a demo account before using indicator on a live real money account. Please keep in mind it's usually best when getting used to a new indicator that you have purchased, no matter whether it is our indicator or another type of indicator offered by another company, to practice trading with it. Now, this also means even if you were using a free indicator, so whether you're just going on TradingView and looking up free indicators that you can try out, where you don't have to purchase them, they're just free open source ones. Whether you're purchasing an indicator and spending money on it, or you're using a free indicator, if you're using it on a live trading account, you are risking money. So when you're getting used to a new indicator, whether you're using a free indicator that you didn't have to pay for or using a paid indicator, it's a good idea to get used to trading with with the indicator, paid or free, before putting money at risk at a live trading account. Now, ultimately, that's up for each trader to decide for themselves. We're just pointing out that it is a good idea to do that, and we certainly recommend that you do that. And until you really have a good handle on using the indicator through a demo account and you are satisfied with the results of using it on a demo account, you feel fully confident in being able to execute entries, stop losses, managing your exits, managing any runners, just going through the whole process of selecting option strikes, just the whole process of trading with it. It's a good idea to get used to that on a practice demo account rather than a live account, especially with something like NDX where the options are very expensive. They're much more expensive than SPX options. So it's even more important on this particular type of situation with NDX to do this. And also, as we pointed out earlier, you could also, while you're doing trading on a demo account, also decide if you want to use the further out of the money options, the 1.5 level to 2 levels away, as we talked about, as a possibility since the NDX options are so expensive. If you're trading earlier in the session, if you go back to that section where we were in trading and re-review that part, or we talked about that, That part is not in the user guide manual. That's just something that we're bringing up as a possibility for you to consider because of the expense of NDX options as compared to SPX, as they're about 4 times as expensive. And SPX is fairly expensive to begin with. So NDX is really expensive. That also gives you the opportunity to make a lot of money, as they're very expensive. NDX has a lot greater range than SPX on any given day. That's one reason why they are more expensive. And but you can also lose a lot more money. So the further out of the money ones are going to be less money out to begin with. So that's less potential money that you can lose. However, there are pros and cons of using those. So it's just really something that you have to try for yourself in a demo account over an extended period of time before making up your mind what particular specific process and option strikes you feel work best for you for trade entries and managing your trades. Also, the trading on a demo account for using on a live account, you can also make a determination of what chart time frame you prefer to use it on, whether it's the 2-minute chart, 1-minute chart, 3-minute chart, 5-minute chart, or say another particular chart time frame all the way up to 30 minutes. Also, which key levels that you prefer taking trades off of, whether it's one or more of the 5 contextual levels, the PML, the PMH, YDL, YDH, YDC levels, or do you prefer taking trades off the bull bear key price level, or do you prefer taking bullish or bearish trades off of either the R levels or one of the S levels? Also, another thing in discovery through practice is on a demo account is also whether you prefer taking 9:30 a.m. opening candle trades, or do you prefer to wait for the session to play out more before deciding what level and the timing of your potential first entry. And also whether you prefer trading in the morning part of the session or say the afternoon part of the session. The afternoon part of the session is where the options, especially 0 TTE, are going to become a lot less expensive, especially on NDX. However, you just need to keep in mind that 0 TTEs do expire the same day at 4 p.m. So while they are a lot less expensive, say later on after say 1 p.m. or 2 p.m. going into the 4 p.m. close, there is a lot shorter window of opportunity because at 4 p.m. they will expire. Okay, so that is going to wrap it up for this video. We appreciate your time, taking your time today to watch this. And again, please look through the user guide and manual before and become familiar with that before trying to trade with the indicator. All right, thank you, and we wish you much prosperity in all your future trading.